All right, let's talk about something that might sound a little technical, but is actually hiding in contracts all around us. We're diving into the accounting standard IND AS 116. Now, by the end of this, you're going to have a simple framework to spot a lease where you might have only seen a simple rental agreement before. Let's get right into it. So, think about your company's contracts for a second. That printer you're renting, those vehicles you use, or maybe even the server space you pay for every month. Are these just simple expenses, or are they actually leases that need to be on your balance sheet? That's the big question the standard really forces us to ask. The standard gives us this very precise definition. But you know what? It really all boils down to two key ideas that we're going to unpack. First, is there an identified asset? And second, does your company actually have the right to control how it's used? If you can answer those two questions, you've basically cracked the code. Okay, so let's start with that first big hurdle, the first gate you have to pass through, the identified asset test. It's pretty simple, really. A contract just cannot be a lease if it's not tied to a specific, identifiable piece of property or equipment. Let's see what that actually means in practice. To figure this out, IND AS 116 gives us three really clear pillars. An asset can be identified if it's explicitly named, if it's implicitly understood, or if it's a physically separate part of a larger asset. Let's take a look at each one. So the first pillar is the most obvious one, right? The contract just spells it out for you. But here's the really interesting part. The asset doesn't even have to exist yet. Let's say your contract specifies a car by its make, model, and color. Well, that car becomes an identified asset the moment it's ready for you, even if it was just a plan on paper when you sign the deal. Okay, this second pillar is a little more subtle. Here, the asset isn't named, but it's identified by the situation. So imagine a supplier has only one specialized machine in their whole inventory that can handle your unique materials. Even if the contract just says one machine, that specific machine is implicitly identified because, well, it's the only one that can possibly do the job. And this is a perfect illustration of that third pillar. If you lease a piece of a larger asset, it has to be physically distinct. So on the left, you see a lease for 5 specific, dedicated fibers inside a bigger cable. That's an identified asset. But look over on the right. Leasing a percentage of the cable's total capacity, that's not a lease because you don't control any specific physical part of it. See the difference? All right, so you found an identified asset. Game over, it's a lease. Right? Well, not so fast. There's a plot twist. Now we have to check if the supplier has a kind of secret escape hatch, what's called a substantive right of substitution. For this right to be a real get-out-of-jail-free card for the lease, it has to be substantive, and that means it has to meet both of these conditions, no exceptions. First, the supplier has to have the practical ability to swap out the asset without a huge hassle. And second, they have to get a real economic benefit from actually doing it. It can't just be a right they have on paper that they'd never use. This example makes it crystal clear. A freight company has tons of identical rail wagons. Swapping one out for another is cheap and easy. That's condition 1, practical ability. And they can do it to optimize their routes and save money. That's condition 2, economic benefit. Since both are met, their right to substitute is substantive. So here's the bottom line, the crucial takeaway. If the supplier has a substantive right to substitute the asset, you don't truly control it. And if you don't have control, you do not have a lease. End of story. But here's a really important protection built into the standard. The burden of proof is on the substance. So if you're looking at a contract and you just can't tell, you're not sure if the supplier would really benefit from a swap, the rule says you have to assume the right is not substantive. which means the contract might still contain a lease. So let's say you've gone through all the tests, and yep, you've definitely found a lease. Before you start diving into all the complex accounting, there's one last stop, the express lane. Ind AS 116 offers a couple of really practical exemptions for simple cases that can save you a whole lot of time. Let's see what they are. First up is the short-term lease. It's pretty straightforward. If the lease term is 12 months or less, and it doesn't include an option to buy the asset, you can usually just expense the payments. No need for complex balance sheet entries. But as we're about to see, defining that lease term is everything. This table shows exactly how it works. In both scenarios, we have a 9-month lease with a 4-month extension option. Now look at scenario A. The extension is at a great price, way below market rate, so you're reasonably certain to take it. That makes the real term 13 months and poof, the exemption is gone. But in scenario B, the extension is at the normal market rate. With no special incentive, you're not certain to extend, so the term stays at 9 months, and you qualify for that simple accounting. The second express lane is for low-value assets. Think of things like the items you see here: tablets, personal computers, basic office furniture, phones. The standard basically recognizes that it's just not worth the time and effort to go through all the motions for a $50 desk phone. And here is the single most important rule for this exemption. You have to remember this. The value is assessed based on what the asset would cost if it were brand new today. This means an old, beat-up car can never qualify as a low-value asset because a new car is an expensive, high-value item. This little rule cleverly stops companies from leasing older, depreciated stuff just to get the accounting shortcut. So we've walked through the tests, the twists, and the handy exemptions. But why does all this matter so much? Well, it's all about moving this from just an accounting theory directly onto the most important financial document your company has, the balance sheet. Getting this right fundamentally changes how the world sees your company. When leases are put on the balance sheet correctly, they show up as both an asset, your right to use something valuable, and a liability, your obligation to pay for it. And that affects absolutely everything, from your ability to get a bank loan to how investors judge your company's stability and overall value. So the next time you're looking at a service contract or a simple rental agreement, I want you to take a closer look. Use this framework. Think about the identified asset, the substitution rights, and the exemptions. You might just discover a lease that's been hiding there in plain sight all along. Thanks for joining me.